All right. So FOMC July 30th, 2025. Numbers came out 4.50. Feds decided to keep the rates as we were anticipating. Um, I'm not surprised. We've kept this rate since December 2024. It's been 7 months. And typically, when that happens, the Feds have to make certain decisions, and so do the institutions and central banks. On a technical standpoint, we have this daily slash 4 hour demand here. To be honest, I'm not really with the high volatility. I'd really want to see if this is a structure that they are creating and holding together, so we can know for sure if like the rest of the week, tomorrow, New York will also respect the same area or retrace to continue back up. We've had 3 solid days of drops. Anybody who's been trading since like 2019 or Steve Morrow, I remember back in the day, you'll see the market give us like 3 drops, 1, 2, 3, and then finally find their way at the bottom to buy from. So yeah, let's see if this is what's really going on. But I never really liked setups that look like this. I like to see a second leg or something that can really confirm. Right now, it's starting to give a really good reaction off this area, which is good. So if like let's say for some reason you wanted to get in very early, I would go conservative. And then the area where stop loss would best be placed is below 32.90, for example. You know, if you guys are anticipating swing buys. All right. So that's what it is.
He's like, hey, I'm married now. Yeah. Yeah.
Hi, Hans.
Mm-hmm.
Yeah, interesting how it reacts with this zone. I'm just not ready to enter yet because there might be a wick when the Jerome starts talking. I don't want to get stopped out for no reason with a wick because they might make one wick down and then push it up because
Mm-hmm.
it's just so big news. What do you think?
1 second, brother.
So I'm just afraid they might sweep again the lower zone.
All right, what did you say?
I'm just saying, like I don't want to enter now before the meeting because I think when they start talking, there might be another sweep, like a
Yeah.
wick down, you know,
Mm-hmm.
catching liquidity, and then it shoots up.
Mm-hmm. Yep. That's why it's important to just speculate first.
Yeah. It's like when they start talking, there's gonna be candles like 150, 200 pips
Yeah.
without any problem.
Right. All right. 15 minutes until Mr. Jerome speaks. The thing about it is like once the numbers come out already, whatever he's gonna say, just kind of backs the decision that was made. And then from there, like, the algorithms and institutions, they step in and show a lot more aggressiveness. But from how things are looking right now, the way we see this structure, if this is a lower high, it's going to keep selling down. But if they respect this area, then we'll know, hey, this might be an area where even up until Monday, we know like this is a reference point, and the price comes back in, and then we can buy it back. Like, for example, this is why over the years, I've slowed down on, over the years, I've slowed down on trying to trade the FOMC uh, choppiness. It's like, but I'd rather just let the days connect so that way when I make that decision, my heart's not beating and I kind
Yeah.
of know and anticipate what comes down next.
Yeah, I completely understand.
Mm-hmm.
It seems like ever since he's implemented tariffs on again, off again, this market's been real choppy.
Mm-hmm.
And there's been some days in my mindset, I'm like, okay, yeah, it's getting ready to do this. But I'm like, then I start questioning myself
Mm-hmm.
and get frustrated. And I'm like, this is not my day to trade. And I'll close it up and go on and do something else for the rest of the day because I was frustrated. I couldn't figure it out.
It sucks. And then after we have kids on the call. Whoever did that, I appreciate you. Just reminding me to disable notation for others. Appreciate that.
Hey, Trump is also having a White House press conference today too, right?
Oh, really? Wow.
Yes, but today's was he might still drop the ball and say something stupid, but today was supposed to be specifically about making healthcare technology great again.
Why? When was it not great?
So they might have dropped the ball already because yeah, when I read that I was like, man, I could see him saying something stupid, man. But yeah, I'm not trading today. I'm gonna wait. I passed my challenge again. This time with an 8K profit target. So it's
Yo,
like
good
three in
job,
the
bro.
last
Good job. Good job.
3 in 7 days, bro. I've never, man, it's crazy. But yeah, I think I want to hop in gold. I wanted to sell gold from the top of this month actually because I was looking at MT5 and I had period separators on the daily and um and it separated the days by month. And I was looking at the chart. I said, I know it's gonna drop. It's gonna drop hard. It
Mm.
notified with profits, but I didn't. I blew my account because of the high the high lot size that I used. I think I was on a point 0.2.
Wow.
But I want to buy. I want to swing it though. I'm gonna swing it. Um, I've been thinking 32.7. What is it? People been talking about 32.75 for like the last like 2 or 3 months. People been saying that gold would touch that. I would love to buy from like 32.90 or and then just have a SL down at 32.74 or something like that.
Yeah, it's funny. We just mentioned that. That'd be the best decision to make if you're looking to swing that low.
Todd has a wife. The wife doesn't know.
Okay.
The heck is that?
That was Albert. The wife doesn't know.
Yo, Ernst.
Yeah, it's Hans, by the way, bro.
Oh,
Hans.
shit. Sorry, bro.
Yeah.
Yeah, Ernst, right. I don't know, but can you please check like the monthly time frame? Because pretty like there's a lot of rejection, man.
You said the monthly time
Yeah, the
frame
monthly time frame.
on gold?
Like, yeah,
Okay.
you see?
Forgive me. Let me go to another one.
All right,
Okay.
because it's pretty crazy, like with all those weeks, bro. And I'm not sure if I'm willing to buy that shit right now.
The way those wicks are set up.
Yeah,
Yeah.
yeah,
See? Yeah, so you thinking they're probably gonna sell back down?
yeah, that's what I'm thinking, man. Like area to basically sell, not to buy right now. You see those weeks, crazy.
Yes. We do see those wicks, bro. We do see them.
But those are bullish dojis, so right?
Shit. You tell me.
I feel you. Yeah, I mean, on a higher time frame, I would say yeah, those are some positive bullish dojis, honestly. But and then those are clear. That's a clear bearish doji over there to the left that I just saw on your screen.
Mm.
Those very clear. Not doji, but dragonfly or whatever it's called. Hammer. It looked like a level was set where that big body is.
I mean, if we're looking at it from that perspective, this looks like it's screaming for wanting to correct. It's like a failure swing from the weekly time frame. That looks kind of crazy. So, looking at the monthly time frame, you swing for months. 32 banks. Remind me your real name again, bro.
Ruben.
Hello?
Yeah, Ruben.
Oh, Ruben. Yes. You swing. Do you be
No,
swinging
no,
for
no, no,
months?
no, no. I'm not swinging. Like mostly I'm a scalper, so I'm not. I don't
Oh,
have that patience, bro.
okay. So what drew you to looking at the
So I'm just basically, like going from, the bigger time frame to the lower time frame. Like, and for the past like couple months, you can see like rejection. That's one psychologically. And when you go to the daily time frame, like I just seen like resistance at the top. Like you can see it clearly. So that's basically my idea.
yeah.
So I don't know if I'm willing to buy Google right now
Mm.
because all of that because monthly and daily time frame. So I'm not sure.
Wembley is something.
Uh-oh,
Sorry.
uh-oh, uh-oh. When it comes to Zoom meetings, it's it's like making sure I close my door before I start pooping. And I think that should it goes unsaid. You guys got to be careful when you jump on Zoom meetings. and you have a noisy background or you're talking and having conversation, make sure you mute first. You close the door first so people don't get into your conversation, your privacy. All right. Crow said, wow, I didn't know Trump was speaking at 4-2. God dang. Yeah, man. Yeah, it's cooked. Why he got to speak at 4? Knowing my man's is speaking at 2, bro. Like that's what I'm talking about. Let me see. He
Well, just know to bank on that he's going to say something stupid.
right.
That's
He
every
gonna
time his
try and
mouth.
push. He gonna try and push the market, y'all.
Mm-hmm.
Compete, yay, man. Always competing, bro. Oh, he's speaking. When is he speaking? Let me see. Oh, July 30th. Well, I'm speaking to clear the schedule. But sir, you gotta I'm speaking to 80, but
Beautiful.
You're gonna be like, I'm gonna say words like you've never seen before.
you've never seen before. Nerds, I don't sorry.
Trump, funny man.
Yeah, bro. Okay. That's a bar, Quells. 227. We all waiting so intently. Yeah. Why they laughing? Mm. 2 minutes.
Bro, I'm scared, bro.
You in some trades?
No, just looking at
Why
the
are you
candles,
scared,
bro.
bro? Like you're not in some
It,
trades. What are
bro,
you
listen,
scared
just
about?
looking at the candle, bro, like they're pumping, man.
Bro, no need to be scared, fam. If your money not on the line, bro, tranquilito, papi.
Alright,
Ain't
alright.
nothing to be scared about, bro. You're not getting shot.
Alright, bro.
Yeah,
Tranquilito, tranquilito.
yeah, bro. Calmo, man. Que se calma. Tranquilo, así.
Yo,
You ain't got 10 lots running on nothing. Like, you ain't got a challenge. You just need the next day or after New York to give clarity. If you don't see clarity, enjoy your life. Enjoyment. Nothing crazy, bro. Hmm. That's how it's supposed to be coming out.
Trying to take my life forward.
Yeah. Weighing at 165 pounds.
Good afternoon. Good afternoon.
About 700 FOMCs, no defeats. Been in the run. Yeah.
I ain't dead.
Hey.
Tumba de ¿no? I don't hear nothing.
This year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So, just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had
I don't know what's going on here, but let me go ahead and refresh.
Want the fastest working GLP-1? For half the price, Roe now offers FDA-approved weight loss injections cheaper, so you can see weight loss results faster. Lose 20% of your weight with the formula from Eli Lilly that hits not 1, but 2 hormones to work harder. Weight loss faster, confidence higher, price cheaper. See
slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course, will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody, and also from a dissenter, is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table, where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you asked about the June SEP, I wouldn't, that you're right, that's what it says, and that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that, we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are?
The difference between an average morning and a Hardee's morning is hearty goodness that lasts till lunchtime, like our smoked sausage biscuit and Frisco breakfast sandwich. Hardee's, goodness in the making.
Less restrictive even. We're going to be, at some point, when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to to slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. Consumers it's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. We haven't reacted to new inflation, but I mean I wouldn't insist upon that. But I don't think I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, though, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say when you think that, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost to the government of keeping rates elevated for longer in terms of interest rate charges?
Yeah, no, that's, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't
we are seeing the markets in real time. As Jerome Powell is still speaking, we can see that the markets are plummeting right now. The main reason is this: the dollar index is still pushing to the upside. Now, as we know, the dollar index has direct correlation with how pairs such as USD CAD correlate, because the dollar has already been very, very bullish since even before Jerome Powell spoke these past couple of days.
Really hard to hear you, Hans.
I'm actually, you just ruined my story, bro.
I'm sorry.
God damn it.
Start over.
All right. So I'm doing a story for Instagram. I'm not speaking to you guys. Just give me 1 second, okay? All right. Okay, so as we can see it in real time, Jerome Powell is still speaking, but the market's already priced in. So as you guys can see, the Dow Jones is melting. Earlier in my webinar, I did say that in the morning, my students knew that the two potential things that would happen is this: if price, just like the last previous FOMCs, whenever rates remain unchanged, what tend to happen is like price can't even go past the previous day's highs. So because of that, we understood that there could be a potential sell-off going on, especially if um nothing has changed to give more of a like bullish undertone, just to say, hey guys, we are going down into the 4.25s or even like a 3.0 type of interest rate. I think that's coming in later, maybe in September or something like that. So right now, I think what we're looking at is we're not trading, but we are speculating. We're seeing that the market, uh, we're seeing that the market might be going down into. We're seeing that the market is more likely going down into areas of demand that are a lot much discounted, meaning we are seeing that the markets is coming back a little bit back deeper to these areas of demand. Meanwhile, the dollar index, which dictates the strength of the dollar, is pushing like crazy, which is why like you can see a pair like USD CAD. Let me change this here. You can see how USD CAD is correlated with the dollar. And so a pair like gold, which you guys know I trade very often, is melting. All right, so it's definitely not risk on. And so far, this is not the anticipation that I had for the most part for gold, but it's all good. This is why we just wait and sit on our hands and we speculate until we actually see clarity. All right, so GU. All right, so GU still bearish from the beginning of the week. EU still bearish at the beginning of the week. Basically, all the money markets that the United States is impacting are going the opposite way to the strength of the dollar, because the dollar just increased by a whole lot since last week. We've been seeing them actually like respect this demand zone area, and since Sunday we've been rallying. So everything boils down to execution mentality. God, and so for me personally, I'm gonna be following up like maybe the next day or in Asia. Yes, I know I look rough, but it doesn't matter. What really matters right now is we just have to basically pinpoint how we're gonna move from here. I believe tomorrow or by Asia. If there's any retracement, I'm definitely gonna be continuing to trade to the downside, because now the market has shown me full clarity that we're not buying for pairs like gold, and US 30 seems to be heading down just to retrace back into demand levels. All right, so in a nutshell, that's how I'm taking advantage of fundamentals and mixing it with the technicals just so I can still maintain my edge. All right. Thank you guys for that. So
What do you mean by
for cutting rates?
We're gonna keep watching a few episodes. I mean, we're gonna keep watching this briefing here, but
waiting to increase.
We pretty much can see how this is playing out. In the morning, we did talk and we said that, hey, at some point, if price just cannot break past the previous day, what did we say would most likely happen? We said it would sell. But we decided not to enter the trades just so we can make sure we did not get ourselves into some unnecessary volatility. So far, this is where we're seeing clear direction. Typically, I noticed that even by the next day, as I was just saying for the story, market probably will retrace, or the next 12 hours, we'll notice that the market will like respect Asia, maybe sweep or retest Asia and continue to the downside. All right. So first target is already pretty much getting there. Tuesday's lows here, as expected. Now, looking at the higher time frames, like the boy, I forgot your name, bro. You might have to change that 32 banks and just so I can get used to the actual real name, bro. Yeah, as we're looking from everything that we were speculating earlier, all this is coming from higher time frames. They had a higher time frame failure swing, and we had a breaking retest, which we talked about earlier. And so now we are selling off. So this is pretty much letting us know where we at. As I had said to a couple of my friends who wanted to know my insight as well, take yourselves, if you are in some heavy buys from earlier, you want to hedge positions to the downside. And then from the positions that are on the upscale right here, you want to scale down. If you had $1, you might want to, close partials in half, close partials in half, close partials in half, and then add positions to the downside, since this thing might even continue selling down to like 32.62. There might be a pullback, but it doesn't mean it's going to just flat out buy to the upside. All right. So that's why, like, even when it comes to fundamentals that other people anticipate, I always wait and see things in front of my bare two naked eyes before I go with anybody else's outlook. Because at the end of the day, once we click that buy or sell, win or lose, it's up to us to make it back. It's up to us to manage the trade. It's up to us to maintain our composure. All right. Any questions, guys?
They were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction. What will it take? It'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting. Will it be dispositive of that? It's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, like some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down closer to 2?
We'll look at everything. It's, as I mentioned, a pretty reasonable base case is that this will be a one-time price increase. And in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right, so we don't again, if we cut rates too soon, maybe we didn't finish the job with inflation. History is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively what we're doing.
Claire. Claire Jones, Financial Times. Just a question on the dollar. We've seen it decline quite heavily this year. I was wondering if there's been any discussion about that at the meetings and to what degree that may be complicating your attempts to get inflation back to target. Thank you.
This goes back to the division of labor between the Fed and the Treasury, as you I'm sure know, and the Treasury only speaks to the dollar. It's not something that's been a topic of major discussion at all at the Fed. I wouldn't say it doesn't come up. If the transcripts, when they come out in a few years, they'll probably reflect some mentions of the dollar, but it would never be a major focus.
And just to follow on, if I may, to Andrew's question, I think the amount of imputed data in CPI now is up to 35%. I mean, is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping and so on, in order to just ensure you've got a good read on what's happening to prices in the US economy? Thank you.
We're monitoring the situation. We do, of course, I mean, as you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But we really need the government data. Really is the gold standard in data, and we need it to be, to be good and be able to rely on it. And we're not going to be able to substitute for that. But if we have to make do with what we have, but I certainly hope that we get what we need.
Jay O'Brien.
Hi, Mr. Chairman. Jay O'Brien, ABC News. President Trump has obviously invoked your name a lot. He has personally pressured you. Are you concerned the way that conduct might impact
Our in-stock cabinet collections are buy one, get one free. Get your dream kitchen for as low as just $159 per.
I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us, and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, the balance of risks, and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Maria Eloisa.
Afternoon, Sir Powell. Maria Luisa Capurro from Bloomberg News. You mentioned a slowdown in consumer spending, and I wanted to see if you could walk us through what was the discussion with the committee around that. We've seen delinquency rates rising for upper income households. How do you see that evolving in the next few months, and how much of a vulnerability that is for the economy going forward?
Consumer spending had been very, very strong for the last couple of years, and had repeatedly, forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say, if you talk to credit card companies, for example, they will tell you that the consumer's in solid shape and that spending is at a healthy level. It's not growing rapidly, but it's at a healthy level. And delinquencies are not a problem. You mentioned high-end delinquencies. I don't know what to make of that. I read the same thing. But so generally, if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate, but it's true, and it was, again, right in line with what we expected, the GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting, some of that can be can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed. And we're watching it closely, but we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about this sense, Governor Waller said that the labor market is on edge, and he was pointing to weaknesses on the private sector. I was wondering, you've said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, any individual's comments. I wouldn't do that. But I think what we know is that private sector job creation, certainly in the last report we'll see on Friday, but had come down a bit. And if you take the QCEW adjustment seriously, it may be even lower, maybe close to zero. But the unemployment rate was still low. So what that's telling you is that demand for workers is slowing, but so is the supply. So it's in balance. Oddly enough, you've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that because of immigration policy, really, the flow into our labor forces is just a great deal slower, and those two things have slowed more or less in tandem. If you look at things like I mentioned, quits. Look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you take the totality of the labor market data, you've got a solid labor market. But I think you have to see that there are downside risks. You don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
Nancy. Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. One more question on the lack of unanimity in today's decision, the two dissents. Was there talk during the meeting? I know you're not going to talk about exactly what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
Sure. So we have an economic go around where people talk about the economy, and then that's yesterday, and then today we have a monetary policy go around all the way around the table. Everyone gives their views. So the discussion around policy was the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. Two of our members felt that the time had come to cut, and that they, for the reasons that they're going to express, I won't tell you the reasons. They'll issue some kind of a thing in the next day or so. But that's the story, and I would say, well argued, very thoughtfully argued all around the table, good arguments, and it's a situation where, an unusual situation. The economy is in good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock, and it's probably not surprising that there would be differences and different perspectives on that, as well as different views of where the neutral rate is, so that different views of how tight policy is. So we have those. I will say what you hope is that people, explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that standpoint.
Okay. All right. I think that's good enough for me. So what is your takeaway, guys, on some of the things you've said? Feel free to speak now, Dan.
Yo, my thing is when will it become kind of like damn, what's the word, man?
Yeah, when will it be time to bring interest rates down, right?
Nah, more like I feel like traders are just like investors and traders are probably immune to the
Hello?
interested in changing the rates.
Bro,
And
where did
and
you
we all
go?
know the dollar is just like
What in the world? He definitely driving, ain't he? Ain't he, chat?
what happened?
Yeah, bro. We cut. You said 3 words, and we ain't hear nothing after that. Then we heard you again, so we definitely deduced that you're driving and you're losing signal.
Oh, okay, okay.
You're driving, aren't you?
Yeah, I'm driving right now.
Okay, you sound perfect right now. So let's bring it back. So your thing is, when do investors and traders? This is where we lost you at.
My question, I got a red light. Can y'all hear me?
Yes.
Okay. So my question is what I've been thinking about during this whole speech is when will traders and investors in the entire market, indices and commodities become immune to whether or not interest rates are going to go up or down? Because
Immune.
I feel like there's a specific, huh?
You said immune? Like immune how?
Like where it won't affect us. Kind of like I forgot the damn word. It starts with a D, where you don't feel anything. Um, but basically, yeah, I'm just wondering when traders and investors will get to that point where they don't feel they don't they don't care what what Powell has to say about interest rates. It's more concerned about the agenda, the full agenda of where the dollar is going and where stocks are taking the market.
Okay. Well, number one, no one is gonna every single person be immune to what uh the head of the federal chair has to say. You know what I'm saying? Like, no way anyone's gonna be immune. That's one. Number two, the full agenda. Average retail traders don't. The average person don't even know. That's why there's always speculation. If everyone knew for sure, no one would even care what this brother would have to say. It's like we already know, bro. You know? So that's number two. Number three, I thought you was asking like at what point will the market actually just flow the way it's supposed to, according to like the interest rates, and how convenient will it be for us as investors to feel less of the weight of the economy as we're trying to also be investors and human beings that will deal with the repercussions of inflation. Now, that would have been a much more clearer question. Um, and what it's not a shot, bro. There's no immunity. Everything that happens with these markets impact us directly or indirectly. This is what we're part of in this society. And on top of that, moreover, this central bank decision affects every other central bank decision, which then impact the interest rate repercussions of mortgages and supply and demand chains for trucks to bring us food and produce, and even down to the emotions of human beings that are on edge every day because they just can't handle um, how expensive life has gotten as we're trying to just handle life as it is, you know? So there's there's never gonna be a point where people become immune to it. Maybe unbothered is the word choice you were looking for. But even then, no one can be unbothered when, as soon as you step out the house, you get a harsh reminder how expensive milk has gotten. You get a harsh reminder how much like life is still in a constant adjustment compared to what it was 10 years ago. And a lot of these corporations are very sophisticated. They're leveraging AI. They're leveraging all the profits they've made these past 4 or 5 years, and then the economy is uneven with those who are working a decent job, a decent paying job, and that right now is not even enough because of how much life has gotten a lot more inflated. You get me? Hopefully, the car signal did not stop from those bars I just dropped.
No, that's a better question. I dig that. I
Yeah,
got you.
there's no immunity here, bro. Unless you're out living outside this planet, or you're living in a country where like the money is not heavily inflated, it's very deflationary to the point where you can live an honest living without having to feel like you gotta work 15 hours and still feel like that's not enough. Or you gotta grind till your teeth fall off just to finally make it. And then when you make it, you gotta deal with people who feel like, oh well, you got all the money. Like how can we be immune to society where this is where society's at? Does anybody else understand where I'm coming from or can chime in?
Yeah, I feel that way, but I got another situation. How long is Jerome supposed to be in office?
Until May 2026.
And as soon, with Trump knowing that, as soon as, what if he doesn't do something foul and try to get him out before then, when he has the opportunity to get him out fairly in 26, then he puts somebody in that just agrees with what he wants and he crashes the market by lowering the rates too low.
Let me tell you something, man. And let me tell you, old head, something else. If the market ever crashes, which it never will, you guys got to remember, if I'm in a car and the person who, okay, if you're in a car with your nephew, that's not your nephew's car, but you let your nephew drive and you're sitting in the passenger seat. If you see that your nephew's about to crash the car, what's your first reaction? Hey, yo, Neff, slow down, brother. Man, hey, pull over, man. Let me drive. Right? Stay with me.
I'm with you.
Every multi-billionaire has their generational wealth money in the stock market. Your group chat and their group chat, not the same group chat.
Right.
I've lived in DC for like 10 years. I used to do valet parking, and I was blessed enough to go and like valet for private political events. I even saw Obama one time. And it started making sense to me that passing on wealth has a lot to do with the shares that were bought in their lifetime in this market. Meaning, if there's ever a quote unquote crash, you best believe these multi-billionaires will do everything in their power and to hit up the government itself because they have ties with the government. They sleep in the same bed. There will always be an injection to keep the economy from crashing. Now, this is why
Let
I
me
said,
let me let me interject there. I agree with you 100%. But we've never had a Mad King before who doesn't give a fuck.
bro, even if we do, the Mad King also has his money in the stock market, bro.
Yeah,
Like,
but he's mad. He doesn't care.
bro, you care enough to make sure your money is not played with. And one of the biggest things he cares about is money. Look, you're going to die. I'm going to die. This market's still going to be around. In fact, it's going to get even stronger because now they're using AI. This market will never crash. Every time since the 17, 1800s, since the, bruh, this market Y'all seeing this, right? This market will never crash. It will deeply correct, but it will never crash. Every time it goes down deep, there's a pile of money that will print, and there's a whole bunch of money that will be uh, sold at the top and bought at the bottom again and again and again and again and again. If 2020 taught you anything, if 2009 taught you anything, is that every time this thing dips, you better have some money ready to put in that joint because that's the best discount that you'll ever have. The market doesn't sell off, it goes on sale because these guys, when they look at money, they're looking at 3, 4, 5, 10 generations. And how do they pass on that money? Stocks, shares, bonds, T notes, real estate. So it's within their best interest, even if the market were to correct deeply, the government itself will put money in there because this is the driver, the fuel behind every economy in the world.
I feel you, but there's just some other elements in there I don't think you're factoring in, like the fact that it's going to affect the poor and what was the middle class even more so, whether it crashes or not, it'll
You're
fall so low.
including that. I didn't. I nowhere in my statement did it say that it's not going to affect the poor.
No, and I didn't say that you did say that, but I'm just saying that what you're talking about is for the people who are in the market investing and not the layperson who's not.
How many times has this market crashed and there have been poor people and rich people?
But the middle class is getting squeezed out, and that's what I'm trying to point to. It's getting smaller and smaller.
From what I had said earlier, we are all aware of that. But at the end of the
So
day,
so it will happen faster if he does what I say he do.
now that is part of a reality that we'll have to fuck around and find out. Yeah. But bro, since the early 1900s, this has happened before. And the best thing people needed to learn how to do is to survive it. And those generations of people, whether black or white, as long as they're part of whichever class that's lower than the upper middle, they still had to survive it. We you're older than me. You know how the market was in 2009. You survived it. You've seen what happened in 2012. We've seen what happened in 2015 and 2016. The point is, if we keep focusing on one president to the next president, we're going to base our life based on every 4 years. The wealthy and the people that sees life for the next 3 to 4 generations, they learn to survive the markets, they learn to survive the economies, and they learn to also find ways to keep their legacy in check. Because one thing that's going to happen is the middle class is going to feel it, the lower class is going to feel it, but a lot of people also in the lower and middle class have been through this before. They've survived it, and the best thing we could do out of this generation is learn how we can leverage knowledge and technology, because everyone who survived what happened in the past, they're using it now to be mindful of what they should do right now. Me included. I had no idea what this market was about in 2008 and 2009. I was just in high school. But the more we go back in time, we notice that even if we were to hear a crash, what's a crash? If this market forever keeps going up every time they retrace, that means those people who had 1,000 million shares up here, they're gonna sell some positions, it's gonna sell back, and best believe huge corporations and anybody who's into investing long term, they're gonna buy right back at the bottom because just like when it's Black Friday, whether you had $150 in your checking, everybody goes shopping when there's a sale. So no matter the president, if the markets dip, we wait for it to dip and we go back in if we can. That's the cycle. It's repetitive. One of my biggest lessons in 2020 was thinking the world was going to end because I saw the market selling off. Not realizing this was the first time I've witnessed a 35% correction. Where is it now? Where is it now? Every time there was a 35 plus correction that they called a crash, it recovered right back. And those who bought from the bottom and understood the situation, they're like, oh, a 30 plus correction? Yeah, we're going in. And it recovers every single time. So even if you're poor or not, the wealth is in the knowledge and the execution and action you take.
Yeah, that's good for us, but that ain't good for the people who don't have that knowledge.
Brother, that's how this world works, bro.
Oh no, you're not explaining anything to me on that one.
Yeah.
You
So
preaching to the choir, but
at
my
the end of
my
the
point is
day,
valid to the point that everything that you just said is true, but the gap gets lessened and it hurts
yes,
more people.
it does. It does, bro. And it hurts all of
And I
us.
don't have any fear where that is concerned. I was just stating it from a point of fact that it's going to get worse.
Yeah. But then again, when we go back in history, King Leopold killed millions of people. Napoleon killed millions of people. Killed, like slaughtered. The bubonic plague happened. Countless wars just to get here. So humans have seen the worst of things, and dare we say it, I don't think they've ever seen really the best of things as long as you're living on Earth. And it's sad. It's sad. But they also gonna create systems where we've never seen this level of technology and societal system before. There are things coming that honestly unprecedented things. Like you might even realize that these guys might be planning on giving everyone in this universe like a basic income. And you'll now rely on them even more than before. And even if you're poor, it's like, well, this is how much you get every month. And you don't have to work, or even if you work, this is how much they're gonna give you. Like they price in a whole bunch of things. So will the poor get poor? Probably. But as long as we have a fight, bro, that's all we can do. And and as long as you can give, give, but we can't save everyone. We can barely save ourselves at times. But this ain't nothing that ain't happened before. Even back to the days of Jerusalem and Babylon, there was always slaves. There was always poor people. There were always rich taking advantage of the system. And there's always a generation that rose up. We just got to decide which one we want to be and which one we're capable of doing, is starting with our own family and the knowledge that we have and the action that we take. That's really it. Can't worry about one president. That's like a lot of worry every 4 years of the new boyfriend, a new boyfriend, a new boyfriend. Ah, damn it, we are here for 8 years with this boyfriend. Like at the end of the day, we just gotta learn how to navigate through every damn boyfriend that exists. That's it. Yep. So as you guys know, my background is Caribbean. Um, my plan is also to get to know the world a little bit better, because as we're speaking right now, there's some people in Palestine that are that just finished burying their last set of kids. There are people in Africa right now that haven't seen what food looks like in days. There are people in Asia right now that don't even know what's going to happen next. And there are people in America right now that are just turning to the other side because the left side has already been burnt by the sun. It's how hot it is, you know? So, so the world is really tough right now. Very tough. All right. Anybody else has any questions? right. So this is how I'm seeing the markets for the rest of the week. Even if we do get a nice pullback, which would be ideal, probably going to continue back down because um, when it came to the anticipation of markets buying or interest rates dropping, that was not the the case today. So for the most part, this is going to be a continuation to the downside. We're fastly approaching 32.48. I think we're going to continue melting even after New York. This 32.50, 48 area is coming from.
Sorry, I can't hear you. Are you talking very far away or?
Can you guys hear me? Is
Yeah,
that
bro.
better? All
This is
right.
way better.
So we're going down to 32.50. As you guys can see, the next area of demand here. You see it? And nothing is stopping this thing from actually buying. The market almost looks like it's crying. It's like, wow, we're not decreasing rates. Wow. And then boom, just like that, we got a melting market. I feel like the market looks disappointed. Disappointed that we're not um disappointed that we're not lowering interest rates. Yeah. You ever seen paint go down a wall? That's what it's looking like. Dan, you know what else my concern is, bro?
What's that?
Social Security income.
Yeah, what I live off of?
Exactly. And what my parents will live off of in about a year or so.
Yeah.
And so even to keep it real with y'all, even that is a plan that me and my family we have to sit down and figure out because now we're talking retirement for my parents.
Right.
Parents that literally invested everything in their kids.
Yep.
So do y'all understand when I say me, when it comes to all of this, we're still going to have to figure it out together, all of us. Some of us going to have to work 10 times harder. Some of us going to have to use what we're handed to make something out of it. And some of us are just going to have to settle and deal with the repercussions because it's a lot. It's not a one size fits all.
That's
But
for sure.
yeah, just thank God for this skill. But at the end of the day, this skill is not an end all be all. There's real life still happening. So let's do what we can. I'm looking forward to a small pullback, man, because gold at this point ain't no buying, bitch. Ain't no buying. All right. Oh, Vic, I didn't notice you came here, bro. How are you doing? It's sad. Yep, there goes a slight pullback. And then we have FOMC. And then after that, we got next week, which all this might retrace back up a little bit. But
You mean NFT, Hans?
what's up?
You said FOMC or NFT?
Shit, I don't even know what I just said.
You said FOMC. It's all right.
Oh Lord. My bad, guys. I could have sworn I said NFP, but thanks for catching me. Yeah, you got it. Yeah. So how do we follow up with us with this kind of market condition? We have Asia, we have London, we have New York. Typically, we get retracements, retests. All of this can help us to find an entry. And sometimes if there's not too clear of an entry, but you know what the overall direction is, you have to divide your position so you can scale in. Don't try and put that lot size that you know you're comfortable about, but then you could divide it up. So if it pulls back a little bit, pulls back a little bit more, you add positions so when it's coming back down, you're in profit. All right. So that's about it for me.
Hey, Hans, I'm going to check out. My alarm went out, so everybody got to get out.
Same here. We're checking out all
Yeah.
together.
Hey, thank you, man. Appreciate you.
Of course.
All right. Thanks, Hans. I'll see you in the chat.
All right.